Well, hi everyone, and welcome to this week's edition of Feeling Smarter. My name's Aaron Dunn, and as always, I'm joined by my co-host Tim Miller. G'day, Tim. How are you?
Yeah, going pretty well, Aaron. How are you doing?
Not too bad, thank you. Well, 30 June is fast approaching, and we are going to look at the topic of benefit payments and income streams,
Yep.
where we know we have a large number of SMSF members drawing pensions. And this time of year, it's not only important to be thinking about meeting those pension obligations, but also considerations around the timing of when we might start pensions and opportunities that we might have whilst pensions are in play. So, Tim, I might get you to start with, I guess, just the simple aspect here of just ticking off that we meet our minimum pension obligations.
Yeah, look, I think, and you and I have spoken about this a lot over the past couple of years in light of information that the tax office have updated from I guess, an opinion point on, well, their position point, not an
Yeah.
opinion point of view, the ATO's position on not paying the minimum. And so, one of the things that we try to drive home every year is to ensure that you've done your calculations based on the previous 30 June or 1 July balances or commencement balances if you commence during the current year, and ensuring that you meet that minimum pension obligation prior to the 30th of June, to ensure that the fund, one, meets the standards of having a pension, and two, in an account-based pension sense, gets its exempt current pension income deduction. So, recognising that for account-based pensions, there's no maximum, versus, say, a TRIS where there is a maximum, but ensuring that you at the very least, take out that minimum that's been calculated on either a full year or a pro rata year basis.
Yeah, and I guess the other area that's worth understanding, especially again this time of year, looking at how benefits are being taken out, the fact that where people are running sort of multiple pension strategies or they might have pension and accumulation, there is some really important steps that need to be put in play, in particular where those individuals are taking more out than that minimum for the year. And that arguably is in light of potentially some of the Division 296 tax measures coming in from the 1st of July 2026.
Yeah, and I mean that's obviously one of them, but the other piece too, and is around the transfer balance cap, and whether or not there is benefit in taking money out as either a pension withdrawal or as a partial commutation from a pension, or if you've got an accumulation interest, whether it's to take a lump sum out of that accumulation interest. And again, it's a subject that we've covered it in some depth, historically, because it's not a set and forget rule. It's one of those areas that people really need to look at on a year by year basis, but also from an estate planning point of view, the breakdown, the components of their multiple interests or their various interests as to where it might actually be beneficial to take any amounts over and above that minimum from.
Mm. I guess let's go back to the beginning and around commencements, because we see years where we have indexation of the general transfer balance cap, which will allow for people to increase the amount of money that they would have in retirement phase. And specifically at this time of year, that decision around whether you hold off on that pension, maybe commencing after the 1st of July, or do you actually look at starting something earlier? So, what are some of the important considerations at this time of year when we might be looking to commence an account-based pension or transition to a retirement income stream in that regard as well?
Yeah, so look, I think primarily from a transition to retirement income stream, there's really almost nothing ventured, nothing gained. Like the whole concept around setting them up, because they're not linked to the general transfer balance cap until you meet a further condition of release, then you would primarily start one because you want to draw down income, right? And by commencing a pension at any point in time, it'll give you access to that 10% of the account balance. So if there's an income need, starting a TRIS at any point could be beneficial. On the flip side of it, when we look at account-based pensions, one of the critical rules is that, and whilst it does apply to TRIS as well, one of the critical rules is if we start on or after the 1st of June, there's no minimum pension obligation for that year. So we can trigger the commencement, right, which will of course trigger a transfer balance account reporting moment where we'll have to provide the report for that June quarter, but it will entitle the fund to exempt pension income on effectively the earnings that the fund generates from that date until the 30th of June. And in addition, there's no minimum pension obligation on the drawdown. So you can actually commence the account-based pension on or after the 1st of June, get an income tax exemption within the fund, but not draw down on the capital in the sense of drawing the income from the fund for that month. So there's a couple of benefits for it. And of course, subject to the fund's balance, right, and the number of members and other sort of key issues, you might be able to do asset segregation. So there may be some significant tax benefits, particularly from, say, a CGT point of view, gained from commencing a pension on the 1st of July if you are looking at some form of asset sales or whatever in that final month.
Yeah, so that 1st of June date, therefore, is hugely important. I think you touched on the fact that, balance is going to be integral here because of the disregarded small fund asset rules,
Yep.
probably very specifically there. But it does then provide you, as you said, with that opportunity to look at the tax position in that sort of final month and say, well, yeah, are we going to have something where we might be realizing assets or getting sizable gains that we can, in essence, exempt through a deemed segregated period in that particular point in time, because we would be moving that fund into an entirely pension environment, and therefore that deemed segregated period would apply. I guess the only thing we need to be conscious of here is, a lot of what we've talked about there is really the SIS focus. We do also have within our tax ruling 2013/5 around when a pension commences and ceases, the fact that a superannuation income stream is something that has a series of payments connected to each other. So we do need to ensure that we create a connection of that income stream so that we don't end up, for tax purposes, which is obviously where our ECPI is linked, into a situation where those amounts wouldn't form a pension, but would rather end up in an accumulation environment. So battling those two things, I think, is an important reminder as well.
Yeah, and I think to take that one step further, almost to give an example of that, it would be because SIS, the leading element there, gives you the capacity to draw pensions on an annual basis. If you don't draw a pension in that first year, you commence on the 1st of June, you don't draw, and then you draw one in the subsequent year, but then you stop that pension, then if you go then to that TR 2013-5, well, one payment doesn't equal a series. And so, even though you think you've had your pension for 2 years, in the tax officer's eyes, you actually haven't had a pension, and so the commutation can be quite critical. And so that's a key point. And I guess the other piece is we often get carried away in the conversations around the general transfer balance cap and whether you trigger from a personal transfer balance cap point of view, the current general transfer balance cap or a future indexed amount. And for so many members, the transfer balance cap really isn't a relevant factor. And also, the $100,000 indexation level that you generally get won't often make a big difference to people when they've started, in the sense of transfer balance cap space and future indexations and other levels. So, if there's immediate tax benefits that can be gained from starting a pension versus tax paid for the sake of having a slightly higher transfer balance cap, then that's something that this time of year people have to weigh up.
Yeah. So I guess just finally, a few other things that in this time of year of tax planning around income streams that we might want to be thinking about. For me, Tim, I look at the fact that it provides an opportunity to be revisiting the structure of those income streams. So, do we have a reversionary nature attached to that income stream or none? And do we want to maybe make changes around that? A lot of clients now will be taking advantage of things like recontributions through to age 74. So again, restructuring pensions here provides a really good opportunity to think about whether you're running one pension or multiple pensions. What are some of the things that come to mind for you around these planning opportunities where we have superannuation income streams in operation within self-managed funds?
Yeah, look, I think the first one, and you just touched on it briefly there when you highlighted reversionary pensions. The whole nature of blended families and therefore whether you've got a reversionary or discretionary style pensions in the sense of who are you going to leave your benefits to? Because it's clear that from a reversionary pension point of view, that's going to transfer across to the spouse, which means if you've got people within your own family, children from a first marriage or something like that, then that super is going to bypass them. And so it's having an understanding and appreciation for the estate planning considerations linked to the various interests that people have. Probably for me, that whole estate planning piece is just as critical on an annual basis as the investment strategy for the fund. And so when you're reviewing your pensions, that's a good time to do it. There was a period of time, both you and I would remember, where people used to always look to do the 1 July pension reset. So what contributions have been made during the year? Should we just stop the existing pension and add money to it? And I think, again, that estate planning piece, more than anything else, dictates that maybe the reset approach is better served by commencing additional income streams. And, then there might be a consolidation point in the future, but always determining what's the right number for the individual.
Yeah, absolutely. Well, I think what we've been able to highlight today is that pensions aren't certainly set and forget. And this time of year, as in the lead up to 30 June, as much as we focus on contributions and getting money in, I think there is also some really important and valuable planning opportunities around those that are in retirement phase as well. So, Tim, thank you once again.
Always a pleasure.
And we look forward to you joining us for our next edition of Feeling Smarter. Take care and bye for now.
See you all.